Good morning. This is your earnings recap for the week ending May 8, 2026. We saw a mixed tape across technology, consumer discretionary, and healthcare as 15 major names reported results. The data this week revealed divergent momentum. Software names trading on multiple expansion, consumer travel showing demand elasticity concerns, and crypto carving out outsized beats against modest guidance. We'll walk through each print with precision, examining what the market's pricing in and where valuation risk may persist. Let's begin. Uber Technologies reported earnings on May 7th. The company delivered an earnings per share beat of 0.63 versus 0.62 estimate, a modest outperformance. Revenue came in at $14.37 billion against expectations that had been reset lower, representing 6.7% year-over-year growth. The stock ticked up 0.1% in after-hours trading, suggesting the market had appropriately positioned itself ahead of the print. On valuation, Uber trades at a forward multiple of 21.97 times, elevated relative to historical context, but justified by their path to consistent profitability. In our view, the company remains exposed to macro consumer spending dynamics, though the data points to stable ride-sharing demand and expanded advertising revenue streams. We'd note the analyst target sits at $105, suggesting modest upside from current levels. Cloudflare reported on May 8th. The company met its earnings per share estimate at 0.16, but investors should note that top-line expectations had been substantially reduced coming into earnings. Revenue delivered $0.61 billion against a reset estimate of $2.17 billion, a clear miss on absolute dollars despite hitting the compressed consensus. Year-over-year growth of 9.3% reflects a maturing growth profile. The stock surged 0.1% after hours, suggesting relief at the miss rather than enthusiasm. The valuation picture here is stark. The company trades at a forward multiple of 212 times and an EV to EBITDA of 869 times. These multiples are extraordinarily compressed on reported profitability. One might argue the market is pricing in dramatic operating leverage assumptions. The data suggests Cloudflare remains tied to enterprise spending sentiment, and the elevated multiples leave limited room for execution disappointment. Airbnb reported May 1st. The company matched its earnings per share estimate at 0.24, but delivered a substantial revenue miss, producing $2.78 billion against $12.24 billion consensus. Year-over-year revenue contracted 32.2%, a significant headwind that reflects normalized booking patterns post-pandemic and weakened international demand. The stock moved 0% after hours, indicating the market had already digested weakness. On the valuation front, Airbnb trades at 34.62 times current earnings and 28.27 times forward, expensive for a business experiencing material revenue headwinds. The data suggests consumer discretionary travel may be normalizing as high savings rates deplete. The analyst target of $149 implies modest upside, but one should consider whether the valuation already embeds the assumption that demand stabilizes quickly. The risks here appear tilted toward continued normalization rather than reacceleration. Datadog reported May 6th and delivered a clean beat. Earnings per share came in at 0.46 against 0.42 estimate, representing an outsized beat on depressed expectations. Revenue printed $0.95 billion, missing the reset estimate of $3.67 billion, though year-over-year growth of 7.6% shows stable demand in observability infrastructure. The stock surged 0.2% after hours and rallied 41.42% for the week, now trading at elevated momentum metrics. The valuation here demands scrutiny. The company trades at 469 times current earnings and 67 times forward. The EV to EBITDA sits at 252 times. One might argue the week's 50+% rally has pushed this name into extended territory, and the analyst consensus target of $177 sits below current price. In our view, Datadog's competitive positioning in observability is solid, but the multiples leave minimal margin for execution misses. The data suggests caution at these levels despite operational fundamentals. Coinbase Global reported May 8th and delivered a blowout earnings beat. Earnings per share came in at 5.14 against 1.49 estimate, an extraordinary $3.65 beat, or 244% above consensus. Revenue hit $1.78 billion against $6.88 billion estimate, showing that the company's profitability inflection came from operating leverage rather than top-line strength. Year-over-year, revenue declined 4.7%. Notably, the stock fell 0.2% after hours despite the massive earnings beat, suggesting some reality check on forward guidance or macro crypto volatility concerns. The valuation is elevated. Coinbase trades at 44.35 times current earnings and 62 times forward. One should recognize that Coinbase remains a leverage play to digital asset volatility and regulatory clarity. The data suggests the earnings beat reflects margin expansion in a period of elevated transaction fees rather than sustainable demand acceleration. The analyst target of $238 implies modest upside, but investors should weigh execution against macro crypto sentiment trends. McDonald's reported May 1st. The company delivered an earnings per share beat of 3.19 versus 3.15 estimate, a modest outperformance. Revenue came in at $7.01 billion against expectations, reset to $27.45 billion, a substantial miss on absolute dollars. Year-over-year revenue contracted 1%, reflecting ongoing macro consumer weakness in quick-service restaurants, particularly international. The stock surged 0.2% after hours, but declined 3.69% for the week, the weakest performer among defensive names. The valuation context matters. McDonald's trades at 23.86 times current earnings and 21.63 times forward. The company maintains an EV to EBITDA of 17.53 times. In our view, McDonald's is navigating a challenging consumer spending environment where value-conscious guests are trading down and traffic normalization remains elusive. The analyst target sits at $345, implying 18% upside, but the data suggests execution risk persists. The RSI of 25.2 signals technical weakness relative to the consumer discretionary setup. Monster Beverage reported May 8th. The company delivered an earnings per share beat of 0.50 versus 0.48 estimate, a clean outperformance. Revenue produced $2.13 billion against $8.29 billion estimate, another miss on absolute dollars despite beat on the per share line. Year-over-year revenue contracted 3%, showing headwind in the beverage category as consumers pull back on premium energy drink consumption. The stock fell 0.1% after hours, but rallied 13.36% for the week, now trading at an RSI of 73.1, signaling overbought technical conditions. The valuation sits at 39.43 times current earnings and 33.92 times forward, with an EV to EBITDA of 29.13 times. These multiples remain expensive for name experiencing revenue decline. In our view, Monster's brand strength and category leadership are durable, but the data suggests macro consumer spending normalization is pressuring volume. The analyst target of $86 implies flat to modest downside. One might argue the week's momentum may have overshot near-term sentiment. Tapestry reported May 8th. The company delivered an earnings per share beat of 1.04 versus 1.02 estimate, a narrow outperformance. Revenue came in at $2.50 billion against $7.85 billion consensus, a material miss on absolute dollars. However, year-over-year revenue growth of 46.8% represents significant momentum in luxury apparel. The stock fell 0.3% after hours and declined 6.07% for the week. The valuation presents a mixed picture. Tapestry trades at 58.2 times current earnings, but only 19.48 times forward earnings, suggesting the market is pricing in deceleration from the current growth trajectory. The EV to EBITDA sits at 33.48 times. In our view, Tapestry's exposure to luxury consumer spending and China demand normalization creates near-term execution uncertainty. The analyst target of $162 suggests upside, but the data indicates the company must sustain mid-40s% growth rates to justify current multiples. One should monitor whether the brick-and-mortar footprint expansion thesis generates incremental traffic and conversion gains. Expedia Group reported May 8th. The company delivered an earnings per share beat of 4.24 versus 4.13 estimate, a marginal outperformance. Revenue printed $3.55 billion against $14.73 billion estimate, a substantial miss on absolute dollars. Year-over-year revenue declined 19.6%, a material contraction reflecting reduced booking volumes as consumers moderate travel spend. The stock surged 0.2% after hours but fell 8.7% for the week. The valuation context shows mean reversion. Expedia trades at 25.29 times current earnings, but only 12.95 times forward, suggesting significant guidance conservatism or market skepticism on demand recovery. The EV to EBITDA of 11.47 times is reasonable on that multiple basis. In our view, Expedia remains leveraged to consumer discretionary spending and faces headwinds from substitution toward direct booking channels. The analyst target of $284 implies 18% upside, but the data suggests near-term booking trends must stabilize before multiples re-rate higher. One should watch corporate travel spending patterns as a leading indicator for leisure normalization. Gilead Sciences reported April 24th. The company delivered an earnings per share beat of 2.01 versus 1.96 estimate, a modest outperformance. Revenue produced $7.92 billion against $29.44 billion reset estimate, a material miss on absolute dollars. Year-over-year revenue growth of 2% shows the company operating in a mature revenue base with limited top-line momentum. The stock surged 0.5% after hours and held steady at 0.67% weekly gain. The valuation sits at 19.69 times current earnings and 15.4 times forward, reasonable for a healthcare name with consistent cash generation. The EV to EBITDA of 13.36 times is modest. In our view, Gilead's portfolio generates steady cash flow, but faces limited growth catalysts absent successful late-stage pipeline advancement. The analyst target of $158 implies 16% upside, suggesting the market sees modest fundamental recovery. The data indicates Gilead remains suitable for income-focused investors, though revenue acceleration would require new product adoption or market expansion. One should monitor HIV and hepatitis C indication expansion in international markets. Zoetis reported May 6th. The company delivered an earnings per share beat of 1.48 versus 1.40 estimate, a clean outperformance. Revenue came in at $2.39 billion against $9.53 billion consensus, another miss on absolute dollars despite earnings beat. Year-over-year revenue contracted 0.5%, showing minimal growth momentum in animal health diagnostics and pharmaceuticals. The stock surged 0% after hours, but collapsed 28.32% for the week, the most severe drawdown in the group. The RSI of 14.0 signals extreme oversold conditions. The valuation context has inverted dramatically. Zoetis trades at 18.68 times current earnings and 16.03 times forward, now reasonable after the week's severe repricing. The EV to EBITDA of 13.31 times is similarly compressed. In our view, the market may have overcorrected on near-term growth concerns, as the animal health category remains underpenetrated in emerging markets. The analyst target of $149 implies 80% upside from depressed current levels. One might argue the data suggests capitulation selling has created asymmetric risk-reward for patient investors. Realty Income reported May 5th. The company delivered a significant earnings per share miss of 0.22 versus 0.40 estimate, representing a miss of 45%. Revenue printed $1.71 billion against $5.93 billion estimate, another substantial miss on absolute dollars. Year-over-year revenue growth of 23.1% shows strong underlying asset appreciation and rent growth, but the earnings shortfall suggests cap rate compression or higher financing costs impacting distributable cash flow. The stock surged 0.1% after hours, but fell 2.33% for the week. The valuation is expensive. Realty income trades at 54.44 times current earnings and 38.14 times forward, elevated for a rate experiencing profitability pressure. The EV to EBITDA of 18.58 times is reasonable, but masks the cap rate environment challenge. In our view, Realty Income's diversified retail portfolio generates stable rent rolls, but rising real estate cap rates and financing costs are compressing yields. The analyst target of $68 implies marginal upside. One should recognize that rate remains sensitive to interest rate trajectory and consumer retail traffic trends. The data suggests investors demand higher yield pickup to compensate for refinancing risk. Kenvue reported May 8th. The company delivered an earnings per share beat of 0.29 versus 0.28 estimate, a narrow outperformance. Revenue produced $3.78 billion against $15.29 billion consensus, a material miss on absolute dollars. Year-over-year revenue growth of 0.4% shows the company operating in a virtually flat category with minimal organic momentum. The stock surged 0.2% after hours and gained 1.74% for the week. The valuation is reasonable. Kenvue trades at 22.4 times current earnings and 15.11 times forward, modest for a consumer staples name. The EV to EBITDA of 13.64 times is similarly compressed. In our view, Kenvue's portfolio of consumer health brands generates steady cash flow in mature categories, but organic growth appears capped absent successful innovation or acquisition strategy. The analyst target of $20 implies 12% upside. One might argue the data suggests Kenvue functions as a yield-oriented defensive holding rather than a growth compounding engine. The company's exposure to dollar strength and international consumer demand may create near-term forex headwinds. Simon Property Group reported May 12th. The company delivered an earnings per share beat of 1.45 versus 1.44 estimate, a marginal outperformance. Revenue came in at $1.79 billion against $6.36 billion reset estimate, a material miss on absolute dollars. Year-over-year revenue growth of 11.9% shows strong underlying performance from retailers and tenant demand. The stock fell 0% after hours and gained 0.36% for the week. The valuation context is interesting. Simon trades at 14.31 times current earnings but 31.27 times forward, suggesting the market expects material earnings compression ahead. The EV to EBITDA of 12.12 times is reasonable on a blended basis. In our view, Simon's dominant mall portfolio benefits from retail consolidation and tenant demand recovery, but the forward multiple spike raises questions about near-term profitability headwinds. The analyst consensus target is unavailable in current data. One should monitor capital allocation toward redevelopment projects and whether Simon can offset secular mall traffic pressure through experiential and food service diversification. AstraZeneca reported April 29th. The company delivered an earnings per share beat of 1.29 versus 1.27 estimate, a marginal outperformance. Revenue produced $15.29 billion against $60.44 billion reset estimate, another miss on absolute dollars. Year-over-year revenue contracted 1.4%, showing mature revenue-based dynamics with limited top-line momentum. The stock fell 0.1% after hours and declined 0.82% for the week. The valuation sits at 27.28 times current earnings and 18.15 times forward, reasonable for a diversified biopharmaceutical name. The EV to EBITDA of 14.86 times is modest. In our view, AstraZeneca's oncology and cardiovascular franchises generate consistent cash flow, but near-term revenue headwinds from generic competition and patent expirations create visibility pressure. The analyst target of $224 implies 18% upside and suggests strong buy consensus. One might argue the data indicates AstraZeneca appeals to value and income investors, though growth acceleration depends on late-stage pipeline progression in immunology and cell therapy. The company remains exposed to healthcare spending policy shifts in major markets. This week's earnings reveal divergent narratives. Software multiples remain elevated, consumer spending continues normalizing, and healthcare faces mature growth dynamics. Watch for rate trajectory impact on valuation multiples. Subscribe for next week's recap.